The RBI's monetary policy has suddenly become very important and interesting, with the second quarter GDP growth disappointing hugely. The policy announcement is on Friday, December 6, and as always, the CNBC-TV18 Citizens Monetary Policy Committee meets to deliberate on the issues before the RBI and its MPC and what they may do. Let me welcome Chairman of our Citizens MPC, Dr. Pranab Sen, and members Sajid Chinoy, Shaumyakanti Ghosh, Samiran Chakrabarti, and Sonal. Sonal and gentlemen, thank you very much for your time. Let me start straight away with what action is expected, because we can look at the background of growth and inflation in a bit. But first, Sajid, let me start with you. Do you think now it calls for a cut, irrespective of the fact that inflation is high?
Lata, we've always been in the camp that there'd be a cut in February. So it was not this meeting, but the next meeting. And I think what you've seen is this delicate trade-off where government, public investment and government spending was doing a lot of the heavy lifting in the last couple of years. And the first signs that public investment has stepped back in the first 6 months of this year, kind of softer private demand has shone through. And that we had kind of worried about and known about. The complication for the RBI is that the economy in the last 2-3 years has been hit by a series of supply shocks. Right? Food supply shocks. And so, average CPI has been 5.8% for the last 4 years. This year it's come off, it's still been 5%.
Yes.
And so that's been the difficult trade-off, that we understand the government's doing the heavy lifting. We understand private sector demand hasn't picked up where it is. But when you've got sustained, repeated supply shocks on high food inflation, the worry is at some point this will spill over. Our sense is this increases the conviction that a February cut happens. I think in December, the central bank, the MPC, sets the stage for a February cut, pivots more dovishly, and more importantly, sets the stage for liquidity management. Because without the liquidity management from December onwards, any cut in February will not transmit into financial markets. So the way I see this is you use this meeting to inject liquidity, pivot, and then ease in February.
No, I think that is an important point that the Reserve Bank will think of. There is also the credibility issue, but I'll take the liquidity argument. Samiran, is there a case for a CRR cut, therefore, since, liquidity, in a way, is going to be challenged even in the days to come? Look at the way the dollar is strengthening and the rupee is declining.
So, Lata, if you just look at the liquidity numbers, the durable liquidity has corrected by almost 2 trillion rupees in just about a month because of mostly the FX sales and the festive season currency in demand. So, one can make a case for some liquidity easing, and not to forget that in the last 10 days or so, the market-based overnight rates are now running about 20 basis points higher than where the repo rate is. In the last few months, it has just been reverse, where it was lower than the repo rate. Now, obviously, we can decide on what instrument is the best instrument to give this liquidity. CRR is a relatively easy one, particularly if you think that pre-COVID CRR was 4%, and that's probably the only variable which has not yet gone back to the pre-COVID levels. There might be some justification for considering a CRR as well. But overall, I think at this time, I will agree with Sajid that some liquidity easing could be the first step towards a broader monetary policy easing through rates.
Okay, well, I'm going to ask the same question to actually all the members. Shaumya, to you as well. You have to rekindle animal spirits. You have to give some confidence as well. So can the Reserve Bank stay away from both a repo and a CRR? Some obvious symbolic action may be needed?
I think I take the point that some sort of a liquidity adjustment is to be done in this policy, because the simple reason is the food inflation is still running close to double digits, and headline inflation was running over 6%, and it doesn't seem to be coming off the cliff very quickly. But the point over here is that there has to be a very delicate balance of liquidity, because if you look into the liquidity management in the last couple of months, what has been happening is that the government cash balances have become the elephant in the room. From a positive number, then to WMA, then again to negative. So it has been fluctuating significantly in the last 2 to 3 months. And we need to remember that a large part of this government cash balances is basically frictional liquidity. So suppose if there are any liquidity injections or management the Reserve Bank wants to do, it has to match that frictional liquidity with frictional liquidity injection itself instead of permanent liquidity injection.
This is what they're doing with the variable rate
repo.
repo.
So from that point of view, I think while the liquidity management has to be done, but there needs to be a debate on how this need to be balanced with an permanent liquidity injection vis-a-vis and frictional liquidity adjustment. But there is also another point is that because of the significant rupee liquidity suck out because of the intervention to support
because of the dollar
rupee,
sales.
that is also adding to the problem of the central
Absolutely.
bank.
So I mean, that's my point, So even if you look at CRR as a more permanent instrument, it looks like this dollar issue is going to be with us. So maybe there is an argument there. Sonal, what do you think?
Lada, our view is we're already late. Monetary policy works with lag of 3 to 4 quarters. The slowdown has been ongoing for 6 months now. So we think it's basically high time to reverse the cycle. If you just go back to what the monetary policy framework is, it is to target inflation 4% plus minus 2%, while keeping in mind the objective of growth. And what has become very clear is that growth is already below trend, and there is no counter-cyclical response that's coming through even now. And therefore, I think the expectations that growth will somehow go back to 6.5%, 7% without a counter-cyclical response looks extremely unlikely. I think the outlook, the entire debate, therefore, is in terms of how much trade-off there is at this stage. Now, monetary policy has to be forward-looking. The one-year forward inflation forecast is very much aligned close to the midpoint. The second round effects have not actually materialized. And the effects, some sort of a nominal adjustment on the effects is warranted as a counter-cyclical tool as well, and we have FX reserves. So I think the argument that the trade-offs are significant because inflation is high or because currency is weak actually does not hold water. And the balance of risk, in my view, definitely calls for supporting growth at this stage because without growth, there are multiple other macro issues that we'll have to deal with. So I think it's time to support growth both via a repo rate cut as well as via a CRR cut, because even the transmission from banking system is going to take time. I mean, banks have been busy collecting high cost deposits. So even if the RBI sort of cuts the CRR now, the entire transmission to the lending rates is going to take time. So we need to act now.
No, I take your point that it takes time to act, but the counterpoint is also that why is consumption weak? Because of inflation, isn't it? Any one you speak to on the street tells you that onions still selling at 90 rupees a kilo. So Dr. Sen, your best place to put where the policymakers hat, can the Reserve Bank do a cut without injuring its credibility as well when the last number is above their mandate? It is 6.2, the October number.
Well, it depends on what you're talking about. I mean, if you're talking about the repo rate, I don't think there's much of a case. The really interesting question is what you do with liquidity management. There seems, one of the standard tenets of economics is that if you are getting inflationary impulses coming from areas over which monetary policy has very little control, and in this case it is food mostly, your main focus should be to prevent it from spilling over into the core. And for that, interest rate management is not the appropriate tool. It is liquidity management. Now, the question is, so I've got a situation where food inflation is nearly double digits, but I've got a GDP growth rate which is significantly below par, 5.4. And so you are getting the liquidity management demands are working on two sides. That is, if you actually open up on liquidity, you run the risk of the non-core spilling onto the core. If, on the other hand, you are too tight with liquidity, then your growth revival may not happen. And Sonal is right, we are running below trend. But I think one has to be a little careful with these growth numbers, because there is a very strong base effect which is playing out, and it will play out in the next quarter as well. It's only in the quarter after that should we expect to see any normalization happening. And we should be very careful about this. The big question out here is that when you're talking about liquidity, do you create a situation where the increase in liquidity is because the banking sector demands liquidity? Or do you create it through an instrument where the liquidity is given to the banks regardless of whether they want it or not?
Okay.
Now, that makes a lot of difference. So in a situation like this, I think the CRR cut is not a particularly good idea. One should focus a little bit more on what do we do with the variable repo.
Okay. Fair point, sir. And there is going to be a lot of debate on this within the Reserve Bank MPC itself. Though CRR is not an MPC instrument, it will be a RBI decision. But in our case, our MPC is going to vote on both. Let me take the vote first. The first question I'm going to ask my panel is, what will the Reserve Bank do to interest rates on December 6th? Sajid,
We have a cut in February, so a hold in December.
hold. Okay. Nothing, no action. Samiran? Soumya?
We are hold.
Okay, hold.
Very similar to Sajid, the hold now and cut in
Okay.
February.
None of you want a cut. Sonal?
25 basis point repo rate cut.
Okay, there you are. We have the first cut. And Dr. Sen?
Hold.
Hold. Okay, so this is 4:1 in favor of holding. Let me take the CRR question. Your thoughts, your vote.
Some liquidity management for sure, not necessarily CRR, but some liquidity management.
I'm taking
yes.
a no for CRR.
But some liquidity.
Okay.
Yeah.
Soumya?
I would paraphrase it saying that CRR should be used as a counter-cyclical tool.
No or yes?
Some, not headline CRR, but yes on some specific products.
Okay. Yes, I'm going with a yes for Soumya. Shamiran?
I think it is likely, it's possible to do.
Okay, I'll take it as likely then, which is more a yes than a no. Sonal?
Yes, CRR cut.
Okay. Dr. Sen?
No.
No. Okay,
Categorical.
so categorical no. Okay, then I'll take it as 2 no's and 3 yeses. So probably more of a chance of a CRR cut. And very quickly now, last vote. When do you see the first rate cut?
February.
Soumya?
February of a larger magnitude possible.
Okay, February 50 bips. Okay, Samiran?
February.
But I think we already have Sonal's vote, right? Sonal is December. So I'm not asking you, Sonal. You can flash December. Dr. Sen?
February.
February. Okay, so just about everyone is expecting a February cut, except Sonal, who thinks that it should be advanced. But what are the arguments about growth itself? Is it as bad as 5.4? As Dr. Sen says, it is just the base effect. How do we see food inflation panning out? All those questions after the break. Welcome back to the deliberations of CNBC-TV18 Citizens Monetary Policy Committee. We have been in conversation with the chairman of our MPC, Dr. Pranab Sen, and members Sajid Chinoy, Soumya Kanta Ghosh, Samiran Chakrabarti, Sonal Verma, and of course, Dr. Sen, the chairman. We've discussed how they think the Reserve Bank will act, but what is the macroeconomic scenario? Will they change any of the growth numbers? To you first, Samiran, how bad is this 5.4 growth, and how much may RBI have to bring down or adjust its forecast?
So before I directly answer your question, I think we need to understand the growth dynamics that we are going through, what is driving this. In our view, in India, the corporate balance sheet is good, the financial system balance sheet is good, the government balance sheet is improving. The problem, if at all, is with the household balance sheet, where because of elevated inflation, we are probably seeing some pressure on purchasing power, etc. Now, for a while, we could gloss over this because of excess savings during the pandemic time, as well as significant growth in consumer credit. Now, both these tailwinds seem to be receding, in fact, might become a bit of a headwind with all the macroprudential regulations that RBI is taking. And on top of it, we had this very peculiar period of low public capex, which probably could have affected the cash flow in the economy and to some extent affected the household balance sheets as well. So I think that's the main reason why we are seeing this sudden deceleration in the growth numbers. But yes, there is significant base effect in this quarter. Our sense is from November onwards, this base effect starts receding quite fast. So it's possible that we get back to 6.5–7% kind of GDP growth numbers very soon. So in that sense, we are readjusting to the pre-COVID growth rates of about 6.5% rather than the last couple of years' growth rates, which were significantly higher than that. So the adjustment in our mind is a smaller adjustment than what the 5.4 number would seem to suggest. In fact, if we just look at the GVA data rather than the GDP data, the decline is much lower. The GDP last year probably just artificially created this perception that the growth decline is very sharp.
Okay, we'll try. There's the GVA data coming up for you. It doesn't look as low if you compared it with GDP. But I want to flush out the GDP, a growth argument a little more. One variable that Samiran obviously did not include for want of time is the global impact. Sajid, how should we understand? There is going to be tariff uncertainty, trade uncertainty. Will that cast shadows on growth and will it start this year itself?
Lots of moving parts. We're so focused on domestic growth inflation dynamics. There's been a huge change globally between the October meeting and the December meeting. I think number one, the odds of a tariff war, trade war between the US and China are very high, or some sort of global tariff war, right? Now, the impact, the collateral damage on Asia and on India could be quite large through at least two channels. One is when you have these tariff wars, there's heightened global uncertainty. In that uncertainty is never a good environment for business, private investment to take place. And we saw that between 2018 and 2020. Number two, less appreciated, starting conditions matter. China is sitting on massive excess capacity. Yes. That's going to the US right now. If tariffs are put on in the US, that excess capacity gets redirected towards Asia, towards India. Both these will hurt growth. Having said that, the tariff war, like the food supply shock in India, is an adverse supply shock. When you've got trade wars, it's like the global supply curve is moving back, which is actually, all things equal, inflationary. So emerging markets are now hit with lower growth prospects, but potentially higher global prices. Exchange rates are under pressure. That's inflationary. The only thing to counter that is you've got deflationary impulses from China. Last thing I'll say is, amidst this tariff war, there's one other thing going on, which is the last mile of US disinflation is becoming very challenging. You are going to get US exceptionalism in the sense that the Fed will be easing less in 2025, which again means a stronger dollar and emerging market pressure. So I'll summarize by saying it's a very challenging global environment, possibly weaker growth, ambiguous effect on inflation, but a sustained pressure on emerging market currencies, which for some countries in Asia makes it harder to cut rates when their external situations aren't as resilient as India's.
Absolutely. And even this Chinese disinflation, going by the noises, even India will be raising anti-dumping duties. There's such a huge cry. Okay, so therefore, inflation, Soumya, how much do you think the Reserve Bank will have to bring it up to? They are standing at 4.5 for the full year. Will it have to go to 4.7, 4.8? And, this food inflation joker in the pack is also there. How do you see inflation trending?
No, I think, first of all, if you ask me the inflation projections for the current fiscal, I think it has to be upgraded. It could be in the 4.8% or 4.9% mark. And the fact that the next couple of months inflation number is not likely to be significantly different from 5% or so, or even more than 5%. So from that point of view, I think this food inflation trajectory or the inflation trajectory is unlikely to die down in the rest of the current fiscal. But to the larger question which Samiran mentioned, I think the problem is now becoming a little more of structural, because in the economy we are having two divergent views. One is the rural economy is holding up. The urban economy is actually showing signs of slowing down. And the rural economy holding up is also adding to the fact that food inflation is getting elevated, because if you look into the consumption basket of the rural populace, a large part of that is on essential items, which includes food. So by default, if the rural economy is doing well, and it has actually done well if you look into their real income in the second quarter, it has gone up much higher than urban. It's a good thing to have rural economy doing well, but at the same point of time, the size of the rural economy or the weight of the agriculture is not more than 50 basis points in the GDP. So while it is good for the economy at a micro level, but it is not good for the economy at a headline level.
Okay. Well, Sonal, your thoughts. Do you think, I mean, there are people who tell me that inflation even in November is going to come close to 6%. So do you see that becoming, I mean, what are your inflation numbers anyway?
Yeah, Lata, I think we've seen some correction in vegetable prices in November. So we think it should head down closer to 5.5% in November and December, further towards 5%. I mean, in terms of the dynamics, I think the vegetable prices should correct, although they remain a source of volatility if you are taking more of a medium-term view, given just the climate shocks that countries are now exposed to. The outlook on wheat should improve going forward as Rabi harvesting starts. Government is looking to sell wheat in the open market. Edible oil, we've seen some drop in prices in some of the Asian countries, palm oil, etc. So it's possible the pace of increase we've seen in edible oil prices in the last couple of months, that starts to taper off. So I think the October obviously was very high, and as a result, FY25 CPI is likely to be revised up from 4.5 to something that's closer to 4.7, 4.8%. But the forward trajectory on food inflation, particularly the more durable components of food inflation, look benign. And I think even the tick up in core in the last print was almost entirely on account of gold prices. The demand-sensitive components of core have actually been benign for over 12 months now. And given the growth outlook we are discussing, I don't think there is a big core pressure. So we think core is going to remain around 3.5% over the next 12 months. So I think the inflation outlook, the forward inflation outlook remains very benign.
Okay, got that. Dr. Sen, for winding up comments, you pointed out that there is an adverse base and therefore this 5.4 is a bit exaggerated pessimism. Do you think growth picks up because of, good Kharif, good Rabi consumption? What's your overall view of both growth and inflation?
My overall view is we are just starting to normalize. We are starting to go back to where we should be. We've had
which is what, 6.5?
Which is around 6 to 6.5 growth, and inflation somewhere in the 5 to 4.5 to 5% range.
Okay.
That's, I think, where we pretty much are going to be. And we're just normalizing in that direction. But as they've rightly pointed out, there are external issues. I think Sajid described them very well. But then we are also on the agricultural side. On the food side, we are missing out what's happening in Bangladesh. So we've got a situation now where potatoes and onions, which are major components of our food basket and inflation, are going to be in excess supply in the short run. And then we don't know what's going to happen after that, depending on what Bangladesh decides in terms of bilateral trade. So we could see a bit of a roller coaster in that particular area. But immediately, I think the food price pressure is likely to come down as supplies are moved away from Bangladesh to the domestic market.
Okay.
So that seems pretty good. But so far as the food inflation is concerned, look, let's be very clear. Food inflation is inherently contractionary, right? And if it is contractionary, given that our growth is now at 5.4, we shouldn't do anything which would make that contraction worse.
Okay.
We should just make sure that it doesn't spill over into generalized inflation. That should be our baseline.
Okay.
Growth will do what it will do. It will do badly next quarter as well, and then will revive. We should be back to 6.5%.
Okay. Well, thank you very much, Dr. Sen and members of the MPC, for giving us a 360-degree perspective of what we are in. clearly some problems on the global front, as well as immediate food inflation. In fact, Dr. Ramesh Chand was specific that the way in which we are designing MSP as 8.2 plus CL into 1.5 is an inbuilt inflationary trend. So we have something to worry on these structural factors as well. But let's see what the MPC does. Thank you very much for joining us on this special MPC deliberations.